Hey guys, it's Respawn and Retire. Last video we went through my portfolio, what I'm going to be doing with this channel, and how you can take advantage of the current economical climate. In this video, we're going to be going through exactly what my portfolio consists of and how you can copy it and follow us along for the journey. Okay, to get started, I have 1, 2, 3, 4, 5, 6, 7, 8, we'll say 7 different ETFs or companies that I've got in my portfolio so far. I say 7 or 8 because 8 is technically the cash that I have on the side that isn't being used currently. Now, we'll start with the first one, which is NDQ. Now, I should preface that all of these are, in fact, weighted the same. So, all of these are 12.5% evenly distributed amongst throughout the portfolio. So NDQ is my first one. NDQ just tracks the NASDAQ. It is a pure top 100 tech play. This covers anything from Meta, Amazon, Microsoft, Nvidia, anything like that is going to be within that tech play. Now, this has historically had quite good returns. I know you can't base everything off history, but we're looking at the top 100 companies. I believe that this is a good solid start to diversifying the portfolio and hopefully having consistent returns in the future. Currently down a little bit, but rallying back. So there is some room to grow there, and hopefully we can see some gains. Our second holding is IOO. This is going to be the top 100 global ETF. So this gives us a bit of more diversity amongst the world instead of just in the US. The NDQ is just a US based tech play. This is more of a top 100 global cap. And this is going to cover things like Nestle, Samsung, stuff that isn't entirely US based, but gives us a bit more broader coverage. That way we're not too skewed in just the US or just tech. Our next one is the IVV. So this is the top 500 US companies. So companies like Apple, Microsoft, Nvidia, Amazon. You'll see there will be a little bit of overlap between the companies. I'm not too concerned about that. The reason is because a lot of these ETFs are very low in fees. And look, I might have a bit of double up on some of the companies within the ETFs. Like I've just said, NDQ probably doubles up a lot with IVV, but I'm willing to run that risk personally, and you might have a different strategy in mind. But for me, I'm not too concerned about the overlap. If anything, it might carry it up a bit more. All right, then next we've got QUAL. So QUAL, however you like to pronounce it. That's also going to be a 12.5% weight in my portfolio. This one screens the most financially solid companies. So instead of just having a specific tech-based or mining-based ETF, this one more covers, this one has a bit of a screening process. So that way companies that enter into this ETF have a very good cash flow, very low debt. This one has slightly low volatility compared to the others, but because of that, it offers consistent returns. So we might not see as much growth with this one compared to the others, but we also might not see as much drawback compared to the others when there are, shifts with current economic situations like the Iran war. Moving on to our next one, we have Semi, and this is for the semiconductors. This covers companies like ASML, TSMC, Nvidia again, anything that's going to be chip related. And this is really the backbone of any EVs, data centers, all of the AI stuff that we're seeing at the moment. Semi, I feel like, is a more long-term play at the moment. Obviously, there is quite a big boom in the AI industry, but I feel like maybe it is still early. We've only really had AI for the last 2, maybe 3 years now with the introduction of ChatGPT through OpenAI. I think AI is still got a lot of room left to grow, but it will be very particular companies. You're seeing a lot of companies pivot into them. I did hear a story the other day about some shoe brand that tried to pivot into AI recently, and I think you will see a lot of companies trying to replicate that. But I think the big companies like with Anthropic and Amazon, Nvidia, OpenAI, those companies that are really pushing to put a lot of money into it, there's still a lot of room left to grow and a lot of application that hasn't been applied yet. So we're going to hold that one for long term. I definitely think there will be some volatility in it, but long term, I think we'll see consistent growth. Now, our next one is going to be Wire. Also, once again, 12.5% holding weight, sorry. With Wire, this is more of like our copper miners ETF. So this is going to facilitate growth in the tech and infrastructure and energy industry. It's going to cover all of our mining. A lot of the miners are, well, a lot of the miners, especially in Australia, will have multiple ores they'll mine. So you'll see some that will just be gold and silver and copper. But this will cover for us things like Rio and BHP and etc. that have, it gives us a bit more exposure to miners without just having only copper miners. So I think we're going to have, this is more of a long-term play again for us. I think we're going to have a lot of choppy sideways action happening with the Iran situation, but I've decided to get in early at a discount. It's definitely dropped off a little bit, pulled forwards ahead recently, but I think it will be probably the most volatile out of any holding I have at the moment, but it also will have the most upside because once things do settle down and mining does continue to go on, I think you'll see a big boom in the industry and we'll be there to catch all the gains, hopefully. Now, our last one is PME. Now, this is a medical company. This isn't actually a ETF. This is the only company that we'll be holding at the moment. PME has a very clear moat. It mainly deals with its medical imaging technology. It is trading well and truly below all-time highs, mainly because about 6 months ago, it was priced to perfection. It was bringing in so much money, had extremely high revenues. Everyone was definitely assuming that it was going to be doing incredible work, and it still is putting up incredible work, but a few of the reports were not at the absolute perfection that people were pricing it into. So the stock has tumbled quite a bit. At one point, it was down 60% from its all-time highs. However, it's started to rally back now with gaining more contracts in the US. So I think that its previous all-time highs, where it was sitting in around about the mid 300s, from what I believe, it's pulled back to about 140. I want to say off the top of my head. I'm not looking at anything at the moment, but definitely, I definitely think it's pulled back a lot more than what it should have, mainly because of what's happening with Iran. We've had a lot of money cycle out. So with the pullback itself that it was having, that on top of this economical situation has had a massive pullback that probably is a bit unjust. So I think that it's going to rebound quite heavily once institutional money returns again and whatever's happening in Iran settles down, and we'll see it return to maybe that like low 200s. I don't think it will go up to the 300s that it was at before, but maybe low 200s, if not higher. Excellent company, great moat, like I said, and definitely one I'll be holding long term. Now, as I said, that we were going to be completely transparent with you guys with where the portfolio is sitting, where it's at, as we go through this journey together. Currently, we are sitting at $8,685. We are down 0.5% at the moment, mainly just due to trying to recoup our brokerage fees. We spent $70 with 7 buyers on this on these brokerage fees, and yeah, we're just trying to recoup those losses at the moment, and so we're sitting virtually flat. We also still have just over $1,000, so we've got about $1,200 in cash at the moment, and yeah, looking to add to it hopefully next week. Going into the month of, well, for the rest of this month, I'll have another buy-in point. I might buy in, if we see another pullback, I might use the cash, or I might just wait another few more weeks, but I am definitely looking to consistently buy into anything that's on a dip. So wire currently, I think, will be the most volatile. There's been a lot of open close noise with the Iran Strait, so we might be able to get a bit more in wire and take advantage of those lower prices, because eventually they will rebound. You know, unless you're betting on the entire mining industry collapsing, which is very unlikely, or things get sorted out and we do get there. It's just about, can I hold out for the long run? The other one we might be looking at potentially is putting more into NDQ. That one is doing quite well, actually. We're currently up 3%. So if we see continuous gains on that, we might top up on that as well. Ones that we won't be looking to top up on at the moment is things like semi or IVV or IIO, just because they're a bit broad and they're trading relatively flat. I like to trade, this is me personally, I like to trade on things or invest in things that are moving. Whether it's up and down, at least I know if it's going up, then we might need to buy in and continue to go up. We are looking at more returns. If it's going down, all the better. We will continue to buy up that. If it's trading flat, I don't like to put money into stuff that's trading flat at the moment, just because I'm not sure what's happening with it. Whereas when there's movement, at least I know what's happening. You know, we've got movement up or down. I can make a decision from there. So currently our portfolio sits at about $10,200, just over $10,200, including our cash. So we've got 8,600, as I was saying before, currently invested. We have about 10,200 sitting in cash, or including the cash, sorry. And yeah, I'll continue to give you updates on what we do next and what plays we're looking to invest in. And if there's any developing news, I'll let you know. Hopefully you've enjoyed the video, and that is us, guys. I'll see you on the next one.
I'm invincible. I can't be vinced. I'm invincible.